Hi there. This is Deb Owen
And Lupe Castaneda.
for another edition of Deb Talks. And today, again, we're doing this all on our own, like big girls.
Yep. No camera person. Apparently,
No
she took
camera.
an extended vacation.
Apparently. Especially in the end when we got to reach out for that court recording. Forgive us at that point.
Yeah.
But today, what we want to talk about, we've been going over the pros and cons of different loans the last several weeks.
Yep.
And today, we're going to talk about the rural development loan,
Yes. Rural development, aka
yeah.
USDA,
aka RD.
RD. Yep.
Right.
Mhm.
So there are obviously some pros and cons to that loan. The first thing that you do need to know about a rural development loan, it is designed for rural areas.
Yes.
Okay. There's different pockets in and around every state that will allow for that. And then there's pockets that do not allow for that.
Correct.
How
do we know?
do we know?
Mhm.
Well, there is a map on their website that gives you a general idea on what it is, because they really do set the parameters, and you can go right into their website, or better than that, just call us.
Yeah.
We'll tell you. Depending on what area you're looking at, if you're in the Twin Falls area, there's literally, it's like a 4-mile radius all around the city. It goes like from the canyon down over past what we call Sugar Factory Road, over to Curry, and then out almost to Kimberly, a mile just before Kimberly.
Yeah.
Going into Kimberly. So if you're inside that, what we just went about, you cannot get a rural development loan.
No.
That
gives you a pretty good idea.
Right. And around here, that means all the other areas are, even up in Blaine County.
Yeah.
You can get a rural development loan there.
Mhm.
You go east to Pocatello, again, there's maps around that city. And as long as you're buying outside of that map, you can do rural development.
Yes.
Idaho Falls is going to be the same thing. Boise, Nampa, Caldwell. There are those maps that if you're inside that map area, you cannot do a rural development loan.
Mhm.
So they really are for rural communities. That was the whole designation of those,
Mhm.
and that has not changed.
Right. And obviously, like anything, before you decide on, I want to buy this home going rural development, get pre-approved first.
Right.
Talk to your lender, talk to us, and we will guide you through that process.
Right.
Yeah. And then we'll let you know if, what properties, what areas.
Right. And when we just do a natural application for people, we do ask them where they're looking at, because that may eliminate that rural development loan. And we'll explain that to you. And then when you get to the nitty gritties, we're going to want an address to pop it in to make sure, because if you're right on that border and you're one side of it or another, they're non-forgiving about the address. That literally, with the true property address, we can pop in the address and we can tell you for sure if it would allow for rural development or not.
Yeah. And Debbie, I had somebody ask me not that long ago, I heard they adjusted that map, and that map has not been adjusted
not in our state.
Not in our state.
Okay. They did have some adjustments, yes.
Okay.
But not in our state.
Yes.
That
and
is correct.
That's where that question comes from. They heard that it was adjusted, but yes.
Right.
In our state, it's still the same.
And the other thing about a rural development loan is manufactured homes. Okay. To say that none of them will fall into that parameter is incorrect. However, most of them will not fall into the parameter, even if the manufactured home meets the HUD guidelines. 1976, hasn't been moved, all declared our property. Those don't fall into it. Now, again, some states do have that because they've done some pilot programs, but ours is not one. Idaho is not a state that will allow it unless it is a brand new manufactured home from an approved dealership. Okay. So that potentially could, if those meet those requirements, fall into being able to do a rural development loan.
Correct.
I'm going to tell you right now, in all my years of doing this, I don't want to tell you how long I've been doing it.
No.
We
know your experience, but no need to go into years.
I have never been able to close a manufactured home with the rural development loan because when push comes to shove, it just doesn't meet the requirements. Okay. So most of the time that will kick it out of the area.
Yeah.
Some of the biggest pro to a rural development loan
Mhm.
is it is another true 0% down loan.
Yeah.
Okay, we talked about VA, which is going to be your very best 0% down if you qualify for that. But a rural development loan is 0% down.
Mhm.
You don't have to have any money down.
No.
So
Mhm.
the con to that, if you have too much money saved in your savings, they also will not allow you. So after closing, they don't want to see more than 10% with your closing cost.
Correct.
Okay.
Yeah.
So, but that's very rarely do we come up with that. It does happen sometimes, but very
Mhm.
rarely do we happen with that. So it's a true 0% down loan.
Mhm.
That doesn't mean there's still not closing costs and prepaids, just your down payment is 0.
Yes.
Now, rural development does have
Mhm.
funding, what they call their guarantee fee. Okay, their
Mhm.
guarantee. So they do charge a fee to use it. That fee is 1% of the purchase price. And then that fee is wrapped into your loan, so you don't have to pay that out of your pocket.
Yeah. Mhm.
And then they have a monthly fee, very much like private mortgage insurance. It's not called that, but it works the exact same way.
Mhm. Yes.
So that one, but that one is very small. That's the smallest you'll probably ever have
Mhm.
on that fee. I don't want to. It's private mortgage insurance. It's not what it's called, but I'm going to call it that.
Yeah.
So it does have a small monthly private mortgage insurance premium,
Mhm.
and that's calculated at 0.35%.
Mhm.
So it's not
Very
that
low.
much
Yeah. So that
to
much.
have 0% out of pocket
Mhm.
for that loan.
It is very low.
So the other thing some of the hardest things about it is they are going to be one that's pretty strict on what the overall debt to income ratio will allow.
Mhm. Yeah. They're one of the strictest. I feel.
Very much one of the strictest.
Mhm. Yeah.
Yes. Which means, if we're pushing what they allow, sometimes we can't get approval that way.
Yeah.
If you have a good credit score, we might see some over their allowable ratios. They are also one that looks at both the front end ratio
Mhm.
and the back end ratio. And what a front end ratio is, I'm just doing all the talking today.
Yeah. No. You're good. You're good.
Sorry.
I jump in when I need to jump in.
It's like,
I'm good.
Johnny, shut up.
No.
But what a front end ratio is, it's just your housing ratio.
Yes.
Okay. And that is limited with rural development on what they want and to give you approval. Then your back end ratio is your new housing expense and your other debts.
Mhm.
And so they also are the least forgiving on pushing what you can get.
Correct. Yeah. And then, so that is one of the cons.
Right.
Because they're very
Because
strict.
what we are seeing a
Mhm.
lot with the higher interest rate environment, not that,
Yeah.
is we're not doing as many of those because it's harder to get into those right now. We love them. We've done them for years.
Yeah.
There's
It is a great program.
It's a great program. And there's really nothing hard about the loan.
Mhm.
It's just getting to fit inside that box that they
Mhm.
have for us.
Which is one of the biggest things.
Right.
That debt to income ratio.
Right. That's what we're finding.
Mhm.
Most of them are being
Yeah.
rejected for is that debt to income ratio.
Yeah.
Not that you can't still. So an example,
Mhm.
okay. Maybe somebody going an FHA loan or a VA loan could qualify for 400,000, but on a rural development loan, it literally could go down to maybe 200 or maybe
Yeah.
250. There's a big difference in what the two amounts can be approved, the loan amounts can be approved for.
Yeah.
So, and maybe I was over exaggerating, but it is
quite a difference.
It's quite a difference when you're looking at those.
And they do, and it is very also in regards to income, household income. I know we've talked about that in the past with
Yes.
other loans, but rural development is a big stickler when it comes to household income,
Right.
and they take that into account. So we actually have to take the gross household income, put
All
it in,
income.
all
in the house.
income, everybody living
Even
in the
if
home.
you have
Yeah.
a child living at your home,
Yeah.
it's all income in the house.
Yeah. And we have to
That's
take
working.
that into account. Mhm.
Yeah. And then and there's not a certain bracket. What they look for is your household income, all income, and how many people are in the household.
Correct.
So to say, oh, I've got a family of 4 and I'm going to be capped at this is going to be different than I've got a family at 2 and I'm capped at this.
Mm-hmm.
So that's one thing we are always looking for too when we're doing those rural development loans is, does it fit in that income parameter?
Yes. Yeah. That's a huge one.
Right. The one thing about it is if you do have more dependents, that income parameter obviously goes up, and they do like a child credit to lower the actual gross income potentially to get you in there.
Yes.
So that's just one of the things that we look at when we're looking at the rural development loan.
Correct. And then in regards to, so we've talked about, how about credit scores?
Credit.
Credit. Yeah. Because it's always a huge one there.
So they will go down to a 600 credit score. But below a 620, it's very difficult to get approval. Not impossible, but it is more difficult to get an approval through below a 620. They have their own system. They have what they call the GUS system. It's their underwriting system that because we're direct lenders, we get to use that for them.
Correct.
So we plug in all the data and we can run to see if they can get an approval or not.
Yes.
If they can't, that is also a pro, believe it or not, is we can look at a manual underwrite for them. Okay.
Yep.
And what that means on any loan type is we're taking the automated findings that the systems tell us we have to take, and we're taking and putting those aside, and we have other parameters to see if we can't still get you approved for a loan.
Correct.
So the lower credit scores below the 620 to 600, most of the time when we're looking at those, we are doing manual underwrites. Which again, a manual underwrite can be done, but it also limits. So you might have, if you were able, their debt ratio and everything could have said, oh, I could have bought at 300,000, but if I have to go a manual, I might be down to 275 or something.
Yes. Yeah.
But that's what we address. That's what we talk about. That's what we do.
Yep.
Right.
And then, then when we look at it that way, we really try to look at everything. But again, it's just so that you understand what we look for when we're looking at the rural development loan.
Right. And the credit, again, we talked about credit scores.
Yeah, the credit score.
But that is it. There isn't one loan that we do that we don't actually dive into the report and find out more about it.
Exactly.
So if we've got collections and we've got judgments, or no, we're not going to see that on there, but if we've got medical collections that might be negated out, we don't have to worry about those, but other type of collections we can't negate out. Past due payments that are current now. So those are the things we're going to look at even on the rural development loan, just very much similar to the FHA.
Yes, correct.
So,
yeah. On the rural development, we have to take into account if the non-purchasing spouse as well.
Correct.
Their debt goes against the debt of the borrower or against the debt to income ratios of the borrower.
And the reason is because it's a government-backed loan and we are in a community property state. So if one of the spouses do not want or can't be, because we've got a different credit score we're working with, can't be on it, that doesn't, we can do away with the credit score, do away with that, but we're going to take any debts that we might see on that non-purchasing spouse's credit, and we're going to put it in on the debt ratios for the purchasing spouse to make sure it still works.
And just to clarify, debt that we're talking about is credit line, trade lines that are appearing on the credit report, not, things that are not appearing, like, power, water, things like that.
Right.
So
right.
Just to clarify,
yeah,
because sometimes people will question.
Child support.
Yeah.
If one spouse has to pay and they can't be on the loan for any reason, that is a debt we are going to count against. I shouldn't say against, in the debt ratio.
In the debt ratios.
Yep.
Yeah.
So, and we will now again, we assets. Okay. If you are getting, because you can put some money down on a rural development loan, you still can, because sometimes, as long as everything else fits, that rural development loan, even putting as little as 3% down, might be better pricing because the interest rate is typically better if you have a if you have a decent credit score. I mean, like a 620 or above. If you're below that 620, you're going to have hits to your interest rate. But if somebody was looking at a 3% conventional, but they can qualify for a 3% or a rural development loan and still want to put that 3% down, you most certainly can.
Yeah.
Just because it's a 0% doesn't mean you can't, or 5% down doesn't mean you can't do it, because your payment will probably be less flipping from a conventional or an FHA to a rural development if the properties and everything else works for the rural development loan.
Very true.
So it's a good loan. It's another really, really good loan that I think it doesn't get used enough, I don't think. And I think, I
probably,
think, yeah, could be just the fact that your debt ratio with that higher.
The state of what is occurring in the current market at this point. But this loan program, we have used it quite a bit in the past.
A ton. It's a great loan. Now there's two different kinds of RD loans.
Yes.
By the way.
Yep.
They have the RD guarantee rate, and that's what all mortgage lenders use. Okay, that can do RD loans or rural development or USDA loans. That is the only loan that a mortgage lender can do. They also have a direct loan, and it's a great, great loan for low income clients. Okay. So if
low income and especially fixed income.
And fixed income, right. So, and we will tell you if we feel like that is a better loan for you. There's pros and cons to that too, but you have to go directly to rural USDA for that one. They do the full loan, they underwrite. And then on that one, and what happens on that one is your interest rate is subsidized. I'm not going to quote their rates out, but I'm telling you their interest rates are heavily subsidized for somebody that qualifies. Their income limits are even a lot less than what they give for guarantee lenders. So their income limit is low. So sometimes people really don't just because of that.
Yeah.
But somebody that is on fixed income, if that's something, we will actually tell them, please go over there, go to direct, because it will be a better loan if you're approved. It's a longer process. Okay, so set yourself up for that. There's nothing wrong with it. And then that's a loan that every single year they will renew your financials every single year. Because if your income is increasing, it might knock you out of that, and then your rate then would go up, having your payment go up. But there's nothing wrong with that loan if that is what works for you.
Yeah, it's been a great program as well for fixed income people or people with lower income.
Yeah. So that's honestly, well, it can be a pro and a con to rural development. So assets. I'm going to go back to
assets.
Assets, because I kind of got away from that. And in most of the time, if you want to put some money down, it can be gifted funds too. Okay, so it doesn't mean it just has to be your money. It can be gifted funds. And just like the FHA loan that we talked about, we do have to source the gifter's money. So that's a loan that's if somebody's gifting you money to use towards a down payment and or closing costs, because remember, this loan still has your closing costs and your prepaids on it, even though it's 100% financing. So if you would get gifted funds to cover those, we are going to need to source those gifted funds.
Correct.
Which means just like before,
we'll need the gift letter signed by participating parties, the person receiving the gifts, the person giving the gifts, and then we'll also need the proof, so the bank statements showing
from
that
the person
gifting had the money in their account.
Yes.
Right.
Yeah.
So, and maybe a few other documents depending on how they give you
They
the
got
funds.
that. Yeah. So again, it's a government loan. We're a lot intrusive. We know it.
We do.
It's just the guideline that we have to meet in order to close on that loan, to have that rural development guarantee in our pocket. And on those loans too, what happens on those, and don't let this, we already figure out the timeline for this anyways when we're doing those loans, is we as a direct lender for rural development, gets everything done, everything ready. Then we have to package the file, even though we're direct lending it. We package the file, we send it to them for them to sign off to say that yes, when they get the true loan from us, and you'll make your payment to Guild. It's not like you wouldn't make your payment to us, but when the investor gets that they're going to actually give us back the money that we gave to you to do that. So it probably takes another 1 day to get it all finished up. But don't let that panic you, because what we do is that's just how we do a loan anyways. It's like, we know this, we know it has to go there. We get everything ready to get over to RD to get it back in order to close on time.
Correct.
It's not.
And then there is one thing that has come up, maybe not so much right now, but when we've utilized these loans quite a bit, we have had received what is information from people, or people call us in a panic saying that their money has run out, the RD money has run out. But it's not that the money has run out, it's just that the funding, they have a certain cycle for funding, correct. On these loans.
Correct, because rural development has to go to, it's a USDA loan, and they do have to go and ask for money every single year. Okay, so it's in the fall time that they have to go ask for that, and there's a window of time typically that says, okay, if they don't get their money, we can't fund any more of these loans. Again, not to in all my years of lending, they never run out of money. I mean, they just have to do that. They get their money back. So there might be a small window of time that we have to be careful about, but we know that as lenders on being able to actually fund on that loan. And it's only been literally a few times that it's like, okay, the money's taken longer to get back to the USDA than what they initiated or anticipated. So we might have, 4 or 5 days that we really can't fund on that loan until the money's back in there for us to use.
Correct.
So, but that happens every year. Every single year, they have to go back to the source that they get their money from. And I'm going to talk to you about that, to ask for money to fund these loans for the coming year.
Yeah.
And that's typically when they're going to change any kind of their guideline too.
Oh, yes.
If there's going to be guideline changes, most of the time, they can do it other times, but most of the time that's when we're going to see, like when you talked about changing of the maps and that kind of stuff, that's when they're going to be looking for those. So.
Yep. And as things come up, we will let you know in any changes that occur.
So do you think we covered it?
I think so. I mean, we there is so much more that comes, with each of these loan programs, and there could be much more, but we wanted to give you the overall information so that if you are wondering and have heard about the loan program, that you kind of have the idea of what we look for or what lenders look for to get you possibly pre-approved in this program.
And we're going to look at any and every program that you qualify for. And we're going to go over that with you too. It's the pros and the cons, and we're going to show you that. And then we're going to nail it down to what's best for you, because it's not about us, it's what's best for you. So we're going to talk about that, and then we're going to go from there when you're finding your home.
Yes.
So we go through that all with you, for sure.
We do.
Sounds like a lot. We got you.
We got you too. We got this and we got you. Yeah.
So, and I don't even have any great tidbit of information. So
We hope you're enjoying the fabulous weather. It's been a great, wonderful a few days with great weather.
Yeah.
So
see what's coming the rest of this week.
I know. So stay tuned and to be continued.
And as always, you have any questions, just reach out to us.
Have a great day.
Now we got to hit the recording. See, this is where we need our friend. I think we had to hit it twice. Yeah, their sister.